Good morning, everybody. My name is Pedro Serra Georgia. I am a subject matter expert at SCORE, and I would like to thank you all for signing up. And I would like to welcome you to our tax considerations when selecting a business entity webinar. Well, at SCORE, we offer free confidential mentoring. We are doing through video and phone and email right now at the moment. And you can meet SCORE mentors as much as you are, as you want, and to tackle all your business matters and questions you might have. We cover a wide range of expertise. We have more than 10,000 volunteers. And even if you need, we can put you in contact with more than one mentor to cover different subjects. We also offer webinars. They are almost all for free. A couple of them involve a minor fee to cover for expenses. If you have a mentor, reach out and to update and do a BIS tune-up. If you don't have a mentor, reach out. You can reach us through our websites, or if you want to get in touch, please leave your name in the chat session of this webinar that we will reach out, we will get in touch after the webinar. So please leave your name in the chat session. Let's start with some housekeeping. In case you have any questions during the webinar, use the Q&A button on Zoom to send us your questions. I will pass them to Ina, to our presenter, during the presentation. And so use the Q&A session. If you have any comments, use the chat session. And watch your email for any approved records and webinar content we will send in about one business day. And there will be a 3 questions e-survey after the webinar. Please stay connected. We need your feedback. So yeah, just going through the Zoom system, use the Q&A button for any questions and the chat button to send any comments. Well, without further ado, I would like to introduce you to Ina Kiseleva, our presenter. She has a huge experience with the subject. Ina, please welcome. I will share my window.
Good morning, everyone. It's nice to be here. Let me just share my screen with you, and we can start the presentation. Awesome. So today we're going to talk about tax considerations when selecting a business entity. In my past webinars or seminars that I've done, I found that there are a lot of questions that come up around the subject matter. And this year we decided to separate and do two webinars, and one of them would be specifically on the selection of business entity from a tax perspective. So I'm going to read you a quick disclosure. This presentation was prepared solely for general informational purposes and is not intended to provide and should not be relied for accounting, business, financial, investment, legal, tax, or other professional advice or services. Before making any decision or taking any action that may affect you or your business, you should consult a qualified professional advisor. The speaker shall not be responsible for any loss sustained by any person who relies on this presentation. This basically means that while the information is accurate, each of your situations are different. And whatever information you learn here today may apply to you in a different manner. And that's why before you take any action, you should really search and advice of a professional. Pedro already covered this. I have experience in public and accounting and worked in the private sector with multinational companies, have vast experience in corporate taxation and multi-state and also international. So here's my contact information. And I believe this presentation will be shared with you within 1 or 2 business days. So, but if you want to write it down, if you will have any questions after the presentation, feel free to reach out to me. So today we'll talk a little bit about the business life cycle, choice of business entity, what the business registration process is, some filing tax returns deadlines, and kind of general understanding of what the calendar would look like for your business. And I also would like to cover a subject of doing business in multiple states, especially right now during COVID, when everyone is working remotely or hiring people remotely. So I think it's very relevant subject matter. Then we'll prepare the checklist for the solution. And as Pedro mentioned, you can, if you have any questions, put them in the Q&A box. I will address questions as we go, and then a majority of questions we'll address at the end. But feel free to ask any relevant questions during the presentation. I think it will only make everybody's experience better. So let's start with the business life cycle. Probably through your research and doing your business and talking with your mentors, you have already kind of gathered what the business life cycle of any company or any business is, right? You start with the startup stage when you start networking, learn how to sell your product or service the best way, implement your new ideas, and then eventually you transition to growth stage, where it's, I guess here it says maturing existing client relationship past 3 to 4 year mark, and then decreasing in staff turnover. You're able to make payroll. So and then we've got the maturity stage, and eventually renewal and decline stage. So this is kind of just general business life cycle. What I would like to cover today actually is business legal and tax compliance life cycle, which is what happens in the background, right? All the compliance and all the paperwork that, all the not fun stuff, because the first slide was the fun stuff that you have to do with your business. This is basically what you need to do to make sure your business is operating legally, right? So when you start a business, you go through registration with the Secretary of State. Depends also on what type of business it is. You register it with the State Department of Revenue. Depending on what state you're in, it could have different name. In Massachusetts, it's Massachusetts Department of Revenue. And then you register it with IRS. During operational phase, I guess you have to maintain books and records. You may find that you need certified, audited, or reviewed financial statements, and you have to hire CPAs to do so. You also have to timely file tax returns and satisfy tax liabilities. And you may be subject to all different kinds of taxes: income taxes, property taxes, excise taxes, payroll, sales and use tax, and so on and so forth. And then at the end, when you decide, you know what, I'm done with this business, and you either sell it, you dissolve it, you move on to your next stage in your life, you've got to make sure that you go through the closing process in the correct and proper manner, so there are no loose ends, so to speak. So what do you need to do when you start a business? Well, first of all, you've got to figure it out. Is it business or hobby? Okay, so what entity do I create to do the business under? Or what's my tax obligation is going to be? Do I need to seek help of a professional? Do I need a separate bank account? So this is just some questions I would like to go over today, and again, if you have any questions as we go along, please feel free to post them in Q&A box. So through my through just doing kind of experience, my experience doing webinars, I came across that a lot of people ask the question, well, what is business versus hobby? How do I know the difference? So this language that I found here on the slide, this is actually from IRS website. This is how IRS would go about to determining whether you have a business or a hobby. The difference is that when you have a business and you have a loss, you can claim that loss against other income, right? And you basically can carry it forward and so on and so forth. When it's a hobby, you cannot take that loss. You cannot benefit from any losses that's generated by that activity. Okay, so the most, I think, important distinguishment that hobby is an activity that is done mainly for recreation or pleasure. I have a picture of horses here because sometimes owners of horses try to claim their hobby and love for horses as a business. And there are a lot of cases where IRS came back and said, you know what? No, this is not a business. This is a pure hobby because there are just various factors that determine whether it's a hobby or a business. But this can apply to anything. You might be a fan of antiques and reselling them, for profit. And then you say, oh, well, that's my business. But in real life, it's not. It's truly just for pleasure and you enjoy doing it. So it is what it is. But there are some factors, determining factors. For example, whether you carry on the activity in a business-like manner and maintain complete and accurate books and records. Usually when you have a hobby, you don't really care, how much you spend on it, or, well, you do care, but do you maintain those books and records so you can then determine how profitable your business, your activity is? Or what time and effort you put into this activity. So if you have a full-time job and then, you have this hobby that you spend, maybe 5 hours a week on, is it really a business? Most likely not. Also, the income from this activity, does your livelihood depends on it? So you will say, well, yes, I'm doing this business and still I have a lot of losses. And well, that's good because it's fine actually, because when we're in a startup phase or during the economic up and downs or whatever other factors might be that impact, the profitability of your business, you may end up in a loss situation. But does it automatically make it a hobby? No, because there are different factors that impact the performance of your business. But do you depend on it? Is it your main activity? Is it something that you do, to sustain your lifestyle? That's what will be the determining factor. As you can see, there are a lot of other factors that you probably should read upon, just to kind of figure out whether your business is truly a business or a hobby, or if you're concerned. And if you have any other questions about this subject, please let me know. So let's talk about the choice of business entities. So let's say you've determined, okay, well, what I'm doing, I'm gonna go with full force and I'm going to create my business. And well, what's the next step? Well, you probably should think of, what form of business do I want to create? Is it going to be a sole proprietorship, limited liability company, general? Maybe I have a partner. Should it be a general partnership or a limited liability partnership? Should it be an S corporation or corporation? Well, how do you know? What difference does it make which entity you operate under? I've created this actually table that I thought might be useful for you. I know it looks busy on the page, but I think when you get the presentation in the PDF format, it will be a good checklist for you to figure out what's the difference between each business entity and which one might be better for you. And of course, again, consult your advisor, whether the attorney or a CPA, to determine exactly which one of these entities might be the best choice for you. So the thing is that there is no like one choice of entity you should, that's better than the other. It really depends on what are you doing, what your personal situation is, do you have partners, what type of partners they are, or co-founders. So for example, let's go just through some of these items here on the this slide. So I have I'm covering here sole proprietor partnership, a C corporation, S corporation, and an LLC. LLC is the limited liability company. So as you can see, sole proprietor is basically, it's same as owner. It doesn't require any registration. If you decide to do a business, you can be a sole proprietor. It's only you, and you're the main person, decision maker. You're putting all the money in, and basically, with the type of business you're doing doesn't require maybe it's small, you're not sure yet, but it would be the sole proprietorship. It's usually reported on your Schedule C and attached to your Form 1040. So there's no separate tax return filing requirement, and kind of very easy to operate, no filing fees with the Secretary of State. If you do it under the DBA, doing business as name, then you might want to register with your town or locality where you live or where your business is located. Partnership is usually, so you're sole proprietor, but here comes somebody and says, oh, you might need additional funds, or you might have joined forces with some of other professionals and said, let's form a partnership and do this business as a partnership. So this entity is considered separate entity from owner. What this means is basically it's its own legal unit. You probably want to have a partnership agreement under which it will operate. And usually partners manage the partnership. So if in a general partnership, let's say one of the people that maybe spends the most time can be elected as a general partner. And partnership files its own tax return. It's usually Form 1065, and then all of the income passes through to the partner. Basically, what this means is that the partnership itself doesn't pay any taxes on the income of the partnership, but rather the partner does on Form 1040. The next level of entities is C corporation. C corporation is probably the entity that provides you the most legal protection. It's separate from its owners. It files its own tax return. It pays its own taxes, and so on and so forth. It's usually operated by managed by the board of directors. It has continuous life cycle. Doesn't matter whether the partner or the founder passed away or not, because it's just a unit of its own. The next unit is S corporation. So S corporation is and also I want to mention that C corporation and S corporation, C and S stands for the actually subchapter of the Internal Revenue Code. Subchapter C governs the C corporations, chapter S governs the S corporations. And S corporations also small businesses that, it's basically kind of small business that can have 100 or less, or at least, not more than 100 shareholders. It's just like a C corporation, it's a corporation. But the main difference is that from a tax perspective is that the income of the S corporation is passed through to the shareholders, and shareholders pay taxes on income generated by the S corporation. And while S corporation files its own separate tax return. There's also major difference of the S corp from the C corporation, for example, is the fact that not everyone can be a shareholder of an S corporation. So for example, foreign persons or C corporations cannot be shareholders in an S corporation, only domestic. The next type of entity is limited liability company. This is actually a fairly young type of entity in the United States. And it's, I find that a lot of businesses operate under an LLC right now. LLC is called a hybrid entity. It's like a chameleon. It can take a face of any other entity. So for example, you can be a sole proprietor and then create an LLC. And so everything about LLC will be reported will be treated from a tax perspective as if you were a sole proprietorship. If you had another partner, by default, LLC is treated as a partnership. However, LLCs can also make an election to be treated as a C corporation or an S corporation. So when you see the description that depends on the type of entity that, type of business, what it means is that if, let's say, you operate as an LLC and one of these items that I have listed here is, the different from sole proprietorship to partnership to C corporation and S corporation, LLC will act as if, depends on what type of entity it is. So, and we'll move on to that. You'll see what I mean. In this, my biggest advice to everyone here, I guess, is that no matter, except for sole proprietorship, if you operate as a partnership, C corporation, S corporation, or LLC, it is absolutely important. It's so important to have either partnership agreement or LLC agreement, your bylaws for C corp or S corp. It's very important, because what happens is that when people start a business, they're all happy, they're excited, they're best friends. If in a couple of years something goes wrong, there's a disagreement how the profits should be shared, losses should be shared, it's always good to have a written document. That's why when you are dealing or doing business with someone else, it's always good to reach out to your attorney and ask them and go through them to properly register your business and create all appropriate documents and negotiate all of the terms at that time, at the start of your business, rather than when you're in hot water. Just a second, I need a sip of water. So I think this slide also in a comparative mode talks about different aspects of doing business in on the either type of the entity. So for example, the tax year. Let's talk a little bit about the selection of a tax year. So generally in the United States, we file taxes on calendar year basis. So if you're a sole proprietor, you are, as an individual, your year end is December 31st. So automatically your sole proprietorship will have the same year end. However, if you are doing business as a partnership, C corporation, S corporation, or LLC that is doing business as partnership, C corporation, or S corporation, you sometimes can choose your tax year. By default, or when you register or for an EIN, you get your EIN, you can indicate what your year end is going to be. But by default, it's usually December 31st. In certain situations, you can choose a fiscal year end. It usually depends on what your, business cycle is. And, in either case, it can be proper, fine, whatever the business, sometimes businesses have September 30th year end, February 28th year end. Sometimes they have 52, 53 week year end, and so on and so forth. Allocation of income. So in sole proprietorship, obviously, 100% of income goes to its owner. 100% of that income is reported on Form 1040 and then taxed. In the partnership, it's based on the agreement and what it says here, if it has substantial economic reality. And in the C corporation, all of the income is allocated to a C corporation and taxed at a corporate level. In the situation with the S corporation, the income is pro rata based on the per share and per day rule. So what this means is that in an S corporation, if you have business, you have, let's say 3 shareholders in your S corporation, and you own 50%, or you, in this example, let's say 50%, and then 2 other shareholders own 25% each. Any income or losses are allocated based on your ownership. There is no variable allocation. It always has, everything that you do has to be pro rata to your ownership. In an LLC, LLCs are flexible, and you can allocate income depending on your agreement, LLC agreement, or you can also allocate losses in such a manner. But usually it is proportional to your ownership. I had a situation, actually, I want to go back to S corporations. In the event, so S corporations, let me just step back a little bit. From a tax perspective, how S corporation is created is you go and incorporate your business, right? You create a corporation with the Secretary of State. It doesn't matter if you're a C corporation, an S corporation, you incorporate and that's it. But then you have to do one more step. For a corporation to be treated as an S corporation, you actually have to make a separate election. And that's what you're going to do. You're going to go to your CPA and say, listen, I created this corporation and I want it to be an S corporation. Your CPA will help you to make an election to treat it as such. So IRS and state tax authorities recognize your entity as an S corporation. But if in certain circumstances, the requirements of an S corporation are not met, it can actually terminate, and it automatically becomes a C corporation. You have a period of time to correct it though. You know, if something went wrong and, you know, then the rules haven't really been followed well, then you can actually, you have a period of time to correct before your S corporation terminates. So for example, an LLC, there could be some disproportion if an LLC that's treated as a partnership, you know, there could be some disproportionate allocation of income and losses, but an S corporation, that's disallowed. So when that happens, your S corporation may terminate. You have to be very careful how you manage your S corporation, especially when you take distributions out. You can't, let's say if you own, you know, 50%, you know, if you pay distributions, you have to pay everyone equal distributions. You can't just take 60% of all distributions or just pay yourself distributions and nobody else. You know, that's kind of, I actually had a client that were doing this, and you know, we had to do a lot of corrections to make sure that they don't lose their S corporate status. Let's move on. Let me just check the time.
Hi, Ina.
Yes.
We have a question. Could you please comment a little bit further about self-employment tax and the distribution in the different entity types?
Sure, absolutely. Let me just go to the next slide, because that's where I'm going to cover some self-employment taxes. So in self-employment taxes, if you operate as a sole proprietor, or you, let's say you're a general partner in a partnership, or you have an LLC that's treated as a partnership, and you're a member manager, right? You're not a limited member. The income of that entity is usually self-employment tax to you. Self-employment income to you. Now, there are some exceptions, depends on exactly what type of entity it is and what it does. If it's real estate, for example, real estate by default is called passive income, so it's not going to be self-employment income to you. But if you are operating a business in the form of sole proprietorship, partnership, or an LLC that's treated as a partnership, most likely that income you're generating or loss is going to flow to your Form 1040 and will be subject to self-employment tax. And self-employment tax, how it works is that you pay 100% of your self-employment tax, which is 15+%, but you get a deduction for half of it on the front of the Form 1040. Please note, if you have an S corporation, you actually have to pay wages to yourself. There's no self-employment, okay, tax in an S corporation, but IRS does look whether you are paying wages to yourself. It's usually required. So you want to set up a payroll and, you know, pay yourself some wages. For example, when I created my practice, I set it up as an S corporation. So I actually do pay wages to myself. I go through payroll service. I don't do payroll myself. You know, that's just the way it is. In an LLC, however, if you have an LLC that's treated as a partnership, you cannot pay wages to yourself. So income is actually self-employment income to you. In the partnership, however, you can pay guaranteed payments to yourself, which is kind of a form of compensation for your services, especially it's done when you have more than, you know, more than one member managers, or let's say you have other employees, let's say, who are members of your LLC, and then everyone gets this guaranteed distributions. It's kind of a form of salary. As to the distributions specifically, sole proprietor, don't remember that in sole proprietorship or LLC, that is a disregarded entity because it has only one owner, and it's treated as a sole proprietorship on your Form 1040. Basically, you know, whatever is left at the end of the day is yours, right? So you can take money out. You're not required to report balance sheet on your tax return. You know, if you need to take money out, you take money out, because technically speaking, whatever you earn in a sole proprietorship or single member LLC gets taxed at 100%, you know, right then and then. In partnership setting, C corporation and S corporation, no, actually, let's step back. In the partnership and S corporation setting, you pay yourself distributions. Usually you don't want to pay, you know, in partnership and S corporation, you are required to keep track of your basis in the company. So if you're gonna pay, and basis is basically kind of an accumulation of money that's already been taxed in some way. So you can distribute that money out, right? You don't want to distribute more than that because that becomes taxable to you. In a C corporation, when you pay distributions, right, it's actually dividends. You have to declare a dividend and then you have to pay the dividend. And once you pay the dividend, that dividend is taxed to the shareholder. So, and that's where also a two level of taxation comes, you know. That's why people say a C corporation, it's not very efficient and from a tax perspective, because the earnings, the same earnings are taxed twice. The earnings of C corporations first taxed at C corporate level when C corporation files its own Form 1120 and pays taxes. And then when it pays out dividends, it's taxed again at an individual level, at a shareholder level. So I think those are kind of more the most distinguishing factors between that you should, you know, between each entity that you should consider when trying to select an entity.
Ina,
Yes.
we have another question.
Mm-hmm.
If you are a single individual or a married couple in a business, is this a best entity to consider, LLC or S corp in this case?
If you are, can you just repeat the question? If you are single?
If you are a single individual or a married couple, is this any best entity to consider in each of these cases?
Okay, so I mean, it really depends on your situation, right? And what type of legal protection you're seeking. Because as I mentioned, sole proprietorship doesn't really offer you any legal protection. General partnership doesn't really offer some legal protection. You know, the owners are responsible for, you know, the debts of the partnership. There is legal protection in the C corporation, S corporation, and some legal protection in LLCs. If you're a single individual, I guess, you know, you can do business as a sole proprietor, C corporation, S corporation, or an LLC. Again, in this case, you will choose how much legal protection you're seeking, right? And exactly, if, let's say, if you planning from a long-term perspective, are you planning on bringing any other, you know, partners in the future or shareholders that you may want to share this business with, you know, or sell it? So that's when you're going to choose which entity you want to operate on under, and how much of self-employment tax you want to pay versus actually paying yourself a salary. If you're a married person, let's say if you're married and you just operate your own business without your spouse, the same thing. I mean, do you have to think about the divorce in the future? So how do you protect your business from then? I think in that case, you should probably consult an attorney, divorce attorney specifically. If you are actually doing business with your spouse, so sole proprietorship obviously is not going to work because it can only be owned by one person. But if you're doing business with your spouse and your partners, you can think about doing it as a partnership, C corporation, S corporation, or an LLC that's treated or as partnership, or makes election to be C corp or S corp. Again, it all depends on how much legal protection you want, what type of business it is. For example, my personal example again, I am actually in business with my husband as well. Not for my practice, for another business. And I think from a legal perspective, it's a small business. I didn't want to create a C corporation, but I wanted probably flexibility of taxation with a good amount of, legal protection. So we created an S corporation actually in this case. But again, my example, because I thought that, S corporation is going to work better for me. It doesn't mean it's an example. That's what you do for yourself. You might think of, you may choose a different type of entity to operate under. I hope I answered that question, but it's a very vague question. And I think if it comes to that, you probably need to kind of consult your attorney to determine which type of entity is best for you. Pedro, are there any other questions?
Yes. Could you please comment about the advantages and disadvantages of registering the company in Delaware or any other states? So why normally we see a lot of companies register in Delaware?
So the reason companies register in Delaware, because Delaware has very flexible corporate laws under which the company may be sued. So a lot of times when companies thinking of going public, they would register in Delaware. So if you actually think, okay, I'm going to register in Delaware, but obviously you're not located in Delaware. Let's say you located in Massachusetts. So you've got to register in Delaware. There's annual franchise tax filing that's required with the Secretary of State in Delaware. If you decide to operate as a C corporation, S corporation, LLC, or partnership in Delaware, you have to register as such in Delaware. Because your business is actually domesticated or located in Massachusetts, you then also have to register in Massachusetts as an out-of-state entity with the Secretary of State. And I'm actually going to cover that in later on, multi-state taxation and registration. So you basically have responsibility to file annual franchise tax returns in Delaware with the Secretary of State. There's a fee that a tax that is determined based on how many shares you authorize and issue, what is the par value, and so on and so forth. Then in Massachusetts, for example, in my example here, you will also have filing requirements every year, because once you register a business in any state, every year or every other year, depends on the state, you have to file annual report. and pay a fee to the state. Usually, for example, in Massachusetts, LLCs have to pay annual $500 fee and file annual report. Corporations pay $125, and partnerships and sole proprietorships don't pay anything in Massachusetts, actually. But that's the main reason, is basically the flexibility of the corporate law, and people do that because it's convenient, but again, it doesn't require you to file income tax returns with the Delaware Department of Taxation, right? But you still have the responsibility of filing with the Secretary of State. Any other questions?
Okay, thank you. Yeah, no, we don't have any more questions right now.
Awesome. So in this table, I also, there's obviously a lot of information, and you feel free to read through them when you have a chance, and reach out to me with some questions that you may have. But I also want to point out the last row here, the retirement plans, depending on the type of entity you choose, will determine what type of retirement plan you can establish for your business and for yourself primarily. Okay, so let's move on. So I'm going to, sorry, here you go. I wanted to quickly go through business registration process, and this question about registering in Delaware came up, but this is basically kind of step by step. What do you do and how you register? First of all, you go to the Secretary of State website. You can register the company yourself. If you already talked to your attorney and they gave you incorporation documents and so on and so forth, you can upload those, or Massachusetts Secretary of State actually provides you a template that you can do. But again, if you're not sure, reach out to the attorney, and they will be more than happy for a fee to help you with the registration. And I am providing here some links that you can also follow. The next step is to get an EIN number on the IRS website. If you have a domestic business, basically incorporated in the United States, you can just go online and get yourself an EIN. Usually, if you operate a sole proprietorship, you're not required to have an EIN, because you have sole proprietorship is the same as the owner, so you're operating under your social security number. But if you're planning on hiring anyone, then I would suggest you get an EIN for your business. Sorry, another sip. After you get your EIN, and I also want to mention that if you have actually a business that is a foreign company, and there's a little bit different registration, there's a little bit different process of getting an EIN, and you cannot obtain an EIN online if you're incorporated outside of the United States. The next step, let's say for Massachusetts residents here, or the ones that are trying to operate in Massachusetts, located in Massachusetts, domesticated in Massachusetts, you pick which one you want. You probably want to go to the Massachusetts Department of Revenue and register yourself with the Mass Tax Connect. Create an account for your company, for yourself, and you then can choose to register what type of tax you're subject to, and that could be payroll, that could be FMLA, and then corporate excise, sales and use tax. You might also have other taxes be subject to, depending on what type of entity you operate. And then, as we mentioned, also if you also on top of your legal name have doing business as or DBA name, you probably want to register it with your town or locality. So, for example, some companies have a legal name, and then they have a division that's their brand name, or your legal name is, you choose a certain legal name, but then you actually operate under a certain kind of brand name that you want to keep, and you want people to see it on your website, or you want to put it on invoice. That's called doing business as, or DBA name. And so any business, any form of business can have a DBA. So that this is something you register with your town. In some states, the process is a little bit different. So for example, in New Jersey, you actually have to register with the state, your DBA name. So moving on. Filing returns and paying estimated taxes. I thought, although we're talking about business entities here, I wanted to cover this because it's important, depending on type of entity you own, what the process is, right? It could be a little bit different. And a lot of, new business owners, when they call me, it's like, well, I know I should get a CPA. I know I should I get a bookkeeper? Should I not? Where do I start? And so what I did, kind of a little bit of a flow chart here, but also gave you kind of step-by-step, what you should consider when you're trying to kind of, build the good bones of your company, so to speak. As I said, this is not fun part of the business. Fun part is that first slide that I talked about, your business life cycle. When you're creating your business, you trying to appeal, to your customers, your marketing, and you love what you're doing. This is kind of the bones of your company, what it's built on, what is holding this company is finances, right? Your records. I think the first advice I want to give you is it's so important to keep business and personal expenses separate. Even if you have a sole proprietorship, open a separate bank account for your business. You can always close it. You can choose a good bank. You don't have to go to Bank of America or Santander. Go to a small local bank. Choose the fees that you are willing to pay. There are so many varieties of plans and different types of checking accounts with different fees. Choose the bank you like, and create that separate bank account just for your bank. So if you need to get a credit card for your business, usually credit card companies are reluctant to give out credit cards to brand new companies. I believe that, if you have a loan or credit card, they want to see at least 3 years of operations. But if you do need to get a credit card, try to get it in your business name, so it's separate from your personal account, from your personal credit card. If you cannot get, let's say, a credit card, just on a practical matter, if you need to use a credit card to finance your business, or it's just easier for you, designate one credit card to business. Do not use it for personal expenses. And the last bullet point here is prepare regular accounting statements, income statements, balance sheet, cash flow statement. These financial statements, they help you to kind of see where you are at. And my advice is that if you can't do it on a quarterly basis, at least do it twice a year. And I think it's important to pick a good software that you will be using to maintain your records, like QuickBooks, for example. There's also Sage. You can keep Excel if you want, as long as it makes sense to you. You know, I understand that having a business, you know, you want to preserve the cash, especially when it's brand new, on important stuff like developing a product, developing a service, on marketing, and so on and so forth. So if it comes to maintaining your record in Excel, because really you don't have that many transactions and you can understand what's going on in Excel, all right, be it, but be consistent. And, you know, and try to do the best job you can. Maintain your records, you know, don't wait for 6 months to do your books. Do it every month, every week, actually. Do it every week if you can't do it every day. You know, obviously you have other important things to do and you don't have a full-time accountant on payroll. So do it once a week, because, you know, the longer you wait, more records accumulate, you forget. And by the time you're ready to do your books, you don't remember what those transactions were, and you have no idea. Banks not always have very good description in the bank statements what each transaction was. Sometimes you just do a transfer, you know, and it just says like the number of the transfer, and that's it. I actually have a client, a little bit of a troublesome client, that the bookkeepers and I have been struggling to basically to get them be more proactive. You know, what happens is that they wait until last minute and then they fall behind. And then they look at their transactions because they're good, they have, you know, good amount of transactions going through the banks. They don't remember what they were. Then we have to find all of the substantiation and documents for each transaction, and it just becomes a nightmare. You fall behind. You know, I really do not recommend doing your business in such a way. Again, stick with the weekly. If you can't do weekly, at least monthly, do the bookkeeping, you know. And also what's important is that this effort to maintain your books and records is shows that your business is not a hobby. But most importantly, for yourself, you can see how your business is doing, you know, because what's not necessarily in the bank doesn't represent how well your business is doing. It's what's on the financial statements, on the balance sheet, and the cash flow statement. So again, be, you know, get your records in good shape. Keep documentation, keep support, right? For tax deductions, you know, for example, meals entertainment is only 50% deductible. Under the new tax reform that came out in the end of 2017, actually entertainment is no longer deductible. So what is the difference between entertainment and meals? Well, entertainment would be when you take your client, you know, to a football game and you pay for the tickets. It used to be that you could deduct 50% of that, no longer deductible. But meals are still deductible, 50%. You know, if you're traveling, keep good log. If you are driving your car, you know, you have a car and you drive for business, you do networking and so on and so forth, maintain your mileage, you know, keep record of your miles, keep a journal. Sorry, for example, I use this app on my cell phone. Let me see what it's called. TripLog. It's fairly cheap. And the moment I get into my car, it starts counting miles. And then what I can do is, depending on the address that I frequently go to, I just put that's home, this is personal, you know, so it only counts business miles. And then every week it sends you reports of your mileage. Do something like this. It's so easy. It's awesome. A lot of people have home offices, especially these days with COVID. Keep in mind that if you have home office, you can take a deduction if you're a sole proprietor or partner. If you're C Corp or S Corp, you can't claim home office deduction on the tax return, okay? Generally speaking. So, but consult your accountant if there are any other options for the home office deduction. Maybe you can lease part of your house, to your business or something like that. Charitable donations, the treatment of charitable donations is a little bit different if you pay them out of your business. Health insurance is usually deductible. And startup expenses, the startup expenses is basically the expenses that you you incur while figuring out whether it's going to be a viable business or not. If you do research and you had to spend money on doing so, you speak to, maybe industry professionals or, so on and so forth, like legal advice, that would consider be startup and organizational expenses. Keep track of those. At the end of the year, or as I mentioned on quarterly or really, semi-annual basis, review your account receivables, your inventory, maybe some of it, maybe some of your accounts receivables are no longer collectible. Or did you attempt to collect them? If you never attempted to collect your accounts receivables, then you can't really, write them off. But if you have attempted and, your client filed for bankruptcy and you will never recover this accounts receivable, maybe it's time to write it off. And, it's a deduction on your financial statements. It reduces your revenue and obviously your tax liability. The same thing with the inventory balances. If you have some, you do your inventory count and there's some obsolete or unusable inventory that you just throw out, and you're not going to use it, then you can write it down. If you sell it to someone else, then obviously you sold the inventory. But if you are going to dispose of it, maybe it's time to write it off.
We have a couple of questions coming up.
Yeah.
The first one is about deducting meals. When you are on a trip for work and then you have meals for yourself, and could you explain a little bit more how to deduct these meals, these expenses? And then what about taking a client out for a lunch to market your company or even discuss work? In this case, is it still only 50% deductible for that expense, for that meal?
So if you're taking your client out for a meal, it's 50% deductible. Okay. Oh. If you are traveling and let's say it's not an overnight travel, generally speaking, your own meals are not deductible. But if you're traveling overnight, then generally speaking, it's 50%.
Okay. Okay, and then there is another question about S Corp. So normally S Corp taxpayers, they distribute to themselves through dividends and not through payroll to avoid taxes. Is this true and appropriate?
So in an S corporation, and that's why I mentioned that S corporations should have payroll for the owners, is generally speaking, it is appropriate to have distributions. However, if you're a business owner and you're capable of paying payroll to yourself and you're only paying distributions, IRS will come after you. So you can probably combine, let's say, just pick a number. Example, let's say your company made $1 million, okay, net income. So you and your co-founder, another co-founder, they split 50-50. You don't pay yourself wages, but you work full-time in this company. And then you pick up, each pick up $500,000 as income on your personal tax return. And you don't pay, obviously, any self-employment tax because it's a S corporation. And then you distribute that $500,000 to each other, each get $500,000. Well, that's a red flag, because first of all, you're very capable of paying market salary to each other, and you just distributed everything, right? So technically, you're paying yourself wages. So what IRS will do, they will come in and they will reclassify the distribution as payroll. And then you will be on the hook for any payroll taxes, any withholdings, and also for penalties and interest on top of that. So what you want to do in an S corporation situation is that you need to determine what would be the market salary for your services, right? Of course, you're going to say, well, my business doesn't make as much. Well, that's the risk of being a business owner, and that's fine. But if you become capable of paying wages, start paying wages to yourself. You don't have to pay wages on the entire profit your company makes, but at least a market, something that you would get or someone would receive if they would get a job at your company doing the same type of, taking on the same type of responsibilities. So that's how you can approach it. I know it's not an exact answer, but again, talk to your CPA, because they would know your business better and they can advise on what reasonable salary might be in your situation, or you might even know what the reasonable salary might be. So definitely in an S corporation, if you're an owner that 100% works in the business, you should pay yourself wages. I hope that answered the question. If it's not, just let me know.
Okay, yeah, thank you.
So moving on, when you start a business or in maintaining, operating a business, you do leasehold improvements, especially, for example, if you lease, or rent office space, you usually start with some sort of renovations. You also buy assets, maintain a list of those assets. Since 2015, 2016, let's say, there are new regs that allow small businesses a deduction, de minimis safe harbor deduction for tangible property. So let's say for a small business, the safe harbor amount is $2,500. If, let's say, you purchased a chair that's $500, you can actually deduct all of it. But if you purchased a piece of equipment that is $5,000, you probably need to capitalize it. So that's what that safe harbor is, that now IRS established that kind of minimum at which you need to capitalize. You do not have to use the safe harbor to capitalize your assets, but you can make such an election to do so. In that case, all of the assets per unit, if the per unit value is less than $2,500, you can write them off immediately. If they're over $2,500, again, it's per unit, then you have to capitalize them. So, but maintain that list, on per unit basis. If you bought, 6 chairs for, let's say you have 6 employees, just put, purchase 6 chairs. So your accountant knows. You need to provide date of purchase, how much you paid for it, including sales tax and shipping. Date of sales, if you sold it or disposed of it, it broke and you threw it out, when did you do it? Sale price if you sold it, right? So because in that instance, you will have to pick up maybe some income or losses depending on whether you sold or for how much and so on and so forth. So maintain that list of assets. Also, when you do improvements, in certain cases, people just kind of lump everything together and say, oh, this is my leasehold improvements. Be careful with that, because sometimes there are expenses, there are items that can actually be deducted. And while leasehold improvements is supposed to be depreciated over, let's say, 15 years, right? There could be items that don't have to be depreciated over such a long period of time and can be depreciated over, 5 years or something, or 7 years. So it really depends on the item. So, you can identify specific items like flooring or, partitions or whatever that can perhaps depreciate it over a shorter period of times. The Internal Revenue Code also provides for special deductions, special depreciation deductions, for example, Section 179, or bonus depreciation. So Section 179, it's an election that you make in a year you place assets in service to deduct 100% of them. Or there's bonus depreciation, and at this time, it's 100% deduction. So I think, with the new tax reform, depreciation rules are quite generous. There are some exceptions, of course, but again, maintain your list and talk to your accountant. If you buy a vehicle, the rules are a bit different. So maybe talk to your accountant, what exact rules for depreciating vehicles. Also, don't forget about tax credits. And this is something to talk to your CPA as well. Depending on what type of business you are and what you do, you can get good credits at federal level or, state. For example, research and development credit. You may think that, oh, this only applies to research companies, that, but it actually doesn't. If you establish a business that develops new processes internally, this may actually qualify for R&D credit. Obviously, a lot of IT companies in their research stage, whatever expenses they incur can qualify for R&D credit. Investment business credit usually applies to manufacturers and research and development companies. And you have to register such in Massachusetts, by the way. I think it's due by April 1st, where you have to establish whether you're a manufacturer or research and development company. But investment business credit is given on assets placed in service. For example, in Massachusetts, it would be in Massachusetts, but a lot of states have similar credits. And so you get a credit for those fixed assets placed in service. Energy tax credits, disabled access credit, work opportunity tax credits, when you hire someone who's been unemployed for a long time or just maybe released from correctional facilities, you know, and you give them a chance, you can actually claim this work opportunity tax credit, and so on and so forth. So keep that in mind, that there could be some credits, you know, that your business may claim. And so talk to your accountant about that. And also want to mention the fixed assets, right? So if, let's say, you do a lot of improvements on the building, it may make sense to do a cost segregation study. And what cost segregation study is that you have engineers come in and they evaluate your building, and they determine if some of the items within the building can qualify for shorter depreciation period. Generally, commercial buildings are subject to 39 straight line year depreciation. But if we can do a cost segregation study, some of the items within that building can be depreciated over 5, 7, or 15-year period, which gives you a much larger deduction in first years of operation. And if your building is already in operation, you can actually file for change in accounting method and amend your prior year tax returns to claim the deduction. So this is a good opportunity, planning opportunity for people in the right situation. Okay. I always like to put some cartoons, some humor, because tax is kind of dry. You know, some people love tax and it's very exciting to them, but for majority, I find, you know, tax is kind of dry and hard subject to listen to. I added also some deadlines for filing with the extension. We're kind of getting close to the to 11 o'clock, so I just want to make sure that you know it's here. Obviously, if you're self-employed, sole proprietor, single member LLC, your due date is usually April 15th. Never mind 2020, that was a special year that we had. So hopefully 2021 will be much better. Partnership LLCs, and that with more than one member, due date is March 15th. It's Form 1065. S corporations, LLCs electing to be treated as a S corporation is also March 15th, and then C corporation, the deadline is April 15th, and then they get the 6-month extension. This is basically the deadlines for the paying estimated taxes. Be careful in Massachusetts when you pay taxes for 1120S and 1120, because there are actually excise taxes in Massachusetts at corporate level and even for S corporation. So just be careful with that. I advise this is the time to do good tax planning. You know, so I advise that you reach out to your CPAs and try to get into, you know, tax planning to see if maybe you need to make additional estimated tax payments, or maybe you should not. So there's no point of giving money to the government if you don't have to make those payments. You know, might as well keep them for yourself. But go through that process, you know. This is good time, like November, December. It's good tax planning opportunity right now. And then record keeping, I thought I would put just kind of the years you should keep specific records for. My practical advice, especially when it comes to tax returns and personal property or real estate, keep things indefinitely. You know, we have a lot of, the current technology is phenomenal, and you can keep everything in PDF. I know a lot of CPAs share information in PDF these days. You know, you don't have to keep paper records. You can scan them, you know, store them somewhere for future use in case it comes up. And I wanted to cover doing business in multiple states, especially during this time. When, let's say if you operate in Massachusetts right now, again, I'm going to keep picking on Massachusetts. I think majority of people are from Massachusetts attending this webinar. But if you know, you have to usually file what your federal return, your Massachusetts return, right? But if you decide to hire someone out of state, then most likely, or you open an office in a different state, even better. Most likely you will be subject to filing requirements in that state as well. So there are ways to avoid double taxation. The income has to be apportioned between the two states, but keep in mind, if you are, let's say, service business and you, let's say you're a plumber, okay, and or electrician, and you're, you know, licensed in Massachusetts and Connecticut, New Hampshire, Vermont, you know, kind of New England, right? If you physically go on your cruise, go to each of those states, you actually have to file in each of those states where you go to. So be careful, because you might be subject to multi-state taxation. Be upfront with your, you know, CPA, talking about what operations you have, how far you travel, if you actually hired someone in a different state, what their responsibilities are. There are some times to avoid this type of, if you just hire, let's say, a salesperson in a different state, that's not a big deal, but still it depends on that salesperson's responsibilities, or whether, you know, some nexus may exist in a different state. So be careful when you come to that. You know, I think I covered a lot of items that I kind of wanted to, or things I wanted to cover, but most importantly, when you dissolve business, it's important to do it in the right way. So I actually put together some sort of checklist for you in case you need to dissolve your business, or you decide to dissolve your business in the future, or you sell it. Just, you know, go through each one of those and see whether one of those can apply to you or not. Talk to you again, to your advisors throughout the process. They will guide you in the right direction. And at this time, you know, I really would like to thank you for attending this. And I wish you, you know, good luck for the rest of this year and next year. Hopefully things will turn around quick enough for our economy to recover and our small businesses to, you know, recover as well. You know, personally, my approach right now, I try to shop locally, and in my business, I hire local, you know, service providers to, you know, to keep everyone busy. And as a CPA myself, you know, I feel that there's enough work for everyone. And so I do work with local bookkeepers, the payroll process providers, if for that specific reason, because I feel that, like, the more we share, the better it's all for us. But at this time, if there are any questions, you know, please let me know. Pedro?
Hi, you know, we don't have any more questions right now. I would like to thank you very much for the webinar, and please don't forget, please everybody, don't forget to fill up our e-survey before leaving.
Great. And if they want, and if you're interested in a SCORE mentor, please go ahead and throw your name in chat and we will reach out to you. We're going to kind of stall here just a little bit in case there's any last minute questions. So please feel free to type those in right now.
Okay.
And I guess I'm not seeing anything coming through, but we very much appreciate. Oh, okay, I see. Well, it's not a question. It's somebody looking for a,
Yeah.
yeah. Okay. Oh, there's a
Nice.
question that just popped up.
Okay, let's see. Well, thank you.
Oh, they tricked us.
Yeah. Oh, that's great. I'm glad that that people enjoyed our webinar.
Yeah, I can say, that throughout the program, the chat, people were overwhelmed. They just loved all the information that you provided, and it
Well, yeah,
was
we have one more question. How to handle to review how to handle S corp salary, the salary.
A salary, you mean?
Yeah, for in an S corp entity. Yeah, I remember you covered this point, but yeah, how to owners can handle salaries in the S corp entity.
Oh, and it looks like
Yeah.
he has a little follow-up. If there is a shortfall, not earning much, if at all, revenue.
Oh, okay, yeah, that's right. If there is a shortfall in a S corp entity.
Is it a question? I'm sorry.
Yeah, how if there is a shortfall in an S corp entity, not so the entity is not earning much, how to handle the salary versus the distribution?
I mean, it really would depend. I'm not sure what level of income we're talking about, but I really would depend. Maybe talk to a tax advisor to kind of get an idea what could be the best. If you're earning too much and maybe it's just break even, then maybe not necessary to pay wages. But if there's a good potential that there could be some scrutiny at some point, that I would advise maybe just ask your tax advisor, because it's a very kind of general question. Really, you need to look at the industry and so on and so forth.
Okay, thank you.
Well, and just to follow up on what I was saying too, I just wanted to let know that throughout chat and the Q&A that there were many positive posts and that people just loved all the information that you shared today. And, we'll be giving another presentation on December 14th, and I will include that link for registration in the follow-up with the recording and the slides, because the slides are just full of just so much valuable information. And as Pedro said, we just want to thank you and thank all the attendees for joining us today, and ask that everyone keep safe.
Yeah, absolutely. And happy holidays. Happy Thanksgiving and so on and so forth. But I think I'll see you in December again.
Thank you.
All right.